Welcome to the Deep Dive. You've brought us a really fascinating document today, the Morgan Stanley Shareholder Letter from March 2014.
That's right. It covers their performance in 2013, but more importantly, it lays out their strategic transformation.
Exactly. And this isn't just, a run through the financials. Our mission here is to dig deeper. We want to really understand the fundamental shift Morgan Stanley was making, moving towards more consistent, sustainable profits, especially after the financial crisis and all the new regulations. Okay, let's unpack this.
Yeah, that context is absolutely crucial. The leadership, writing back in 2014, painted a picture of Morgan Stanley as, well, diversified. They talked about combining their, quote, world-class institutional franchise, so that's investment banking, trading with a leading wealth management organization, and a strong and growing investment management business.
Three pillars.
Three pillars. And the core idea, the main goal management was pushing, was balance, using these different parts to get stability, smoother revenues, and ultimately better shareholder returns than that old, more volatile pre-crisis model.
And 2013, the year they're reviewing in this letter, was really the test case, wasn't it?
Yeah.
They kicked off the year with this 6-point strategic plan specifically to boost returns. And according to them, they made real headway on every single point.
They did, and I think the biggest structural move, the one that really signals the firm's future direction, was all about wealth management.
Yeah.
They bought out the remaining 35% of that Smith-Barney joint venture. Suddenly, they were the sole owner of, well, one of the biggest wealth management outfits globally.
The scale there is pretty staggering when you look at the numbers. Client assets in wealth management grew 13% to $1.9 trillion.
Yeah.
It's just enormous.
It's huge, and that scale is the bedrock of their new strategy for resilience. The letter spells out the benefits clearly. Sizable and stable revenues, a substantial deposit base, and this is really key from an analytical view, low relative capital usage.
Okay, hold on. Let's pause on that low capital usage bit. For, listeners maybe less familiar, why is wealth management considered so light on capital compared to, say, a big trading desk?
Yes.
Fundamentally, it comes down to how they make money and what the regulations demand. Wealth management is mostly fee-based, right? They charge for advice, managing assets, handling client transactions. It's not like proprietary trading or underwriting complex deals where the bank itself has to hold vast amounts of capital. I think Basel III rules just in case markets go sour.
Okay.
Fee income is steadier, and it doesn't load up the balance sheet with high risk-weighted assets. So it acts as a kind of counterweight to the ups and downs of the institutional trading side.
And you see that payoff, that efficiency, immediately in the performance numbers they reported. The profit margin in wealth management jumped from 12% the year before to 18% for the full year 2013. It even hit 19% in the last quarter.
Right.
That jump really shows they managed to integrate that huge acquisition pretty quickly and, well, efficiently.
Absolutely. Getting to an 18% margin on almost $2 trillion in assets, that puts them right at the top among their peers, especially for a business they just fully taken over. It really validates making wealth management that stable, high-margin core.
Okay, so that's the anchor. Now let's pivot to the traditional engine room, institutional securities. This area needed some pretty serious work, didn't it? Especially fixed income and commodities, or FICC.
It did. And this is where you really see strategy being driven directly by the new regulatory landscape. The old institutional business model was heavy on RWA risk-weighted assets. Just to clarify for everyone, RWA is how regulators figure out how much capital a bank needs to hold against the riskiness of its assets.
Got it.
Basel III basically made certain businesses, especially large volatile ones like FICC, incredibly expensive from a capital perspective.
So the strategy wasn't just about tweaking things. It was basically a forced de-risking exercise.
Exactly. Take the decision to sell off part of their physical commodities business. That wasn't just, a random choice. The letter explicitly says it was done to make the remaining client-focused business more capital efficient and consistent with the regulatory environment. They were actively shedding the stuff that just ate up capital without generating enough return under the new rules.
And the results are, well, pretty dramatic when you look at the RWA reduction numbers. They slashed RWAs by almost half from $390 billion back in 2011. They beat their own targets for 2013 and 2014 and were aiming to get under $180 billion by the end of 2015. That's aggressive, a very clear response to Basel III.
Extremely aggressive.
But hang on, cutting FICC, the fixed income and commodities part, by nearly 50%, Wasn't there a risk there? I mean, were they worried about losing massive market share to competitors, maybe rivals who weren't restructuring quite so fast? How did they square that circle in the letter?
That's a really important point. The letter addresses this by highlighting where they didn't cut back, essentially, the client-facing businesses. So in investment banking, they were still consistently top 3 globally in M&A advice and IPO underwriting.
Okay.
And in equity sales and trading, they actually grew their share of the revenue wallet, ranking number 2 worldwide. So it suggests the cuts were very targeted. It seems they weren't cutting client relationships or core advisory work. They were cutting the firm's own risk and the capital intensity tied to holding certain assets. They kept the high-profile revenue-generating parts while shrinking the capital footprint dramatically.
Right. So connecting the dots here, you can kind of see the elegance of the overall plan. They traded that market volatility and capital inefficiency for the stability and high margins of wealth management. And shedding those inefficient, high RWA assets, that frees up billions in capital, doesn't it? Capital they can then either put to work in those better returning capital light areas or, and this is key for investors, give back to shareholders.
Yes, precisely. That shift, moving from just focusing on the sheer size of the balance sheet to focusing intensely on capital efficiency, that's really the central narrative running through this whole letter.
Okay, let's talk about the other side of the profitability coin, expenses. They made a big deal about cutting costs. The firm committed to reducing its expense base, and they hit a target of a 79% expense ratio, even after accounting for some higher legal costs and specific write-offs. How exactly did they manage that kind of discipline? What levers were they pulling?
Well, the letter mentions broad-based cost reduction efforts, but I think the main drivers were twofold. First, integrating the wealth management joint venture efficiently, and second, streamlining the infrastructure supporting that smaller institutional securities footprint. I mean, simply running a less asset-heavy trading business inherently lowers your overheads, everything from tech spending to real estate. Hitting that 79% ratio showed they followed through on a major cost-cutting promise.
And we shouldn't forget the third pillar, investment management. It seems like that part of the business also had a good year.
It absolutely did. Investment management had, quote, the highest level of revenues and income from continuing operations since the financial crisis in 2013. Assets under management there grew 10% to $373 billion. It just adds another layer of that stable, recurring fee income complementing the wealth management side.
Okay, so strategy, execution. Let's get to the payoff for shareholders because, well, here's where it gets really interesting. The market clearly liked what it was seeing. The concrete result was a massive 65% total shareholder return, TSR, in 2013. The firm definitely saw that as a big stamp of approval on their whole transformation plan.
Yeah, and that positive market reaction clearly gave them the confidence for the next big step, returning capital. They started a $500 million share repurchase program. That might not sound huge today, but it was their first significant buyback since the really dark days of 2008.
It's a big signal.
A huge signal. It basically declared the post-crisis repair phase officially over. They were back in the business of returning excess capital.
But looking ahead, the growth path they outlined for 2014 and beyond wasn't about going back to the old ways, like ramping up proprietary trading again, was it?
Not at all. It was about leveraging the assets they now had, especially that growing deposit base flowing in from the massive wealth management business.
Using the deposits.
Exactly. This is where the newly efficient balance sheet gets deployed strategically. That stability from the fee businesses gives them access to this large, relatively cheap pool of customer deposits. And the plan was to monetize those deposits by significantly growing their lending activities. Specifically, they talked about building out banking and lending services for their wealth management clients. So think mortgages for high net worth individuals, securities-based lending, that sort of thing. And on the institutional side, they plan to use their optimized U.S. bank structure to expand corporate lending. It essentially turns those client deposits into fuel for generating interest income.
Okay, so it all ties together. The stability from wealth management, the capital efficiency from reshaping institutional securities that directly enables this new growth engine.
Yeah.
Lending, funded by stable deposits, which is fundamentally a much safer banking model.
Precisely. And they expressed confidence, provided they executed well and kept pace with evolving regulations, that they could increase both the buybacks and the dividend over time, growth and returns, but on a more solid foundation.
The letter also touches on the softer side, the corporate culture. They made a point of highlighting core values, putting clients first, leading with exceptional ideas, doing the right thing, giving back. How does that philosophy fit in with this pretty relentless drive for efficiency and capital return we've been talking about?
Well, it's definitely presented as an integral part of the post-crisis narrative. The argument, essentially, is that running the business well is doing the right thing for clients and shareholders. For instance, focusing on capital efficiency and reducing risk. That aligns with doing the right thing by making the firm safer and more resilient, avoiding the kind of excessive risk-taking seen before the crisis.
Hmm.
And they offered a tangible example for the giving back value, launching the Morgan Stanley Institute for Sustainable Investing. The letter frames this not just as, good PR, but as a real initiative using their core expertise, capital markets, to tackle societal and environmental challenges. It
Mhm.
was an attempt to show their financial muscle could align with broader goals.
So what does this all mean? Summing it up, management saw themselves, or wanted to be seen, as a fundamentally changed company. One focused squarely on consistent execution, delivering for clients, managing risk prudently, and using capital smartly. The message was clear. The wild swings were out. Sustainable, predictable returns were in.
And they backed that up with hard numbers on financial strength. They highlighted a Basel I Tier 1 common ratio of 12.8% and this huge $202 billion global liquidity reserve at the end of 2013. Those aren't trivial figures. They underscore that the firm wasn't just solvent, it was heavily fortified with capital and liquidity to withstand future shocks.
Right. So the key takeaway for you, the listener, really is that Morgan Stanley's strong 2013 wasn't just luck or a rising market tide. It was the result of a very deliberate and rapidly executed strategic overhaul. They anchored the firm on the stability of wealth management, ruthlessly cut risk-weighted assets in the institutional business, and essentially transformed themselves from a potentially volatile trading powerhouse into a more resilient, capital-efficient financial services provider built for the post-crisis world.
A major pivot, successfully navigated, at least according to this snapshot in time.
Indeed. But let's end with a final, perhaps provocative thought for you to mull over. Given that strategic shift described in 2014 towards capital efficiency and maximizing returns, particularly through deposit-based lending, how much did Morgan Stanley's stated commitment to doing the right thing and initiatives like their Institute for Sustainable Investing actually influence where all that newly freed up capital and lending power was directed in the years that followed? Raises an interesting question, doesn't it? About the constant balancing act between pure financial strategy and those stated corporate values. Something to think about.